Thank you for joining us today. The time is 10 o'clock. Let's begin. First things first, the disclaimer. The information that we are going to discuss today is current of the date and for information purposes only. It is not intended to address the specific needs of any individuals, and it also does not serve as investment, taxation, or legal advice. The products and services discussed in this webinar, if any, do not constitute an offer to sell or a solicitation in connection with any product or service. The topic of today's webinar is U.S. Taxation 101. So here's some information about the speakers today. I am Shirley Nelson. I'm Chinese. My Chinese name is Mei Shihui. I had my undergraduate degree in engineering from Singapore, and I subsequently completed a Juris Doctor degree from Case Western Reserve University in Cleveland, Ohio. I'm currently an associate advisor at JGUA. If you'd like to reach out to me, my email address is on the screen. So my area of focus is investment, taxation, and insurance review. I speak and write English and Mandarin Chinese. I'm currently a licensed attorney with inactive status, which means I'm not currently practicing law. I'm also a registered patent attorney with USPTO. In the area of finance, I have passed the CFA level 1, and I intend to complete the upper level in the coming years. I'm going to turn off my camera soon, so hopefully you will have a larger screen area for viewing the presentation slides. But before I do so, I'd like to proudly introduce to you my colleague, Amanda.
Oh, thanks so much, Shirley. So hello, everyone. My name is Amanda Herrick-Smith, and I'm a senior advisor at John Allman & Associates with 14 years of experience. Some of the specialty areas I do include education planning, both saving and student loan paydown strategies, estate planning, retirement planning, and tax planning and preparation. So at John Allman & Associates, we have the privilege of serving clients since 1979, which will actually be 41 years this August. When we begin a relationship with our clients, we help by actively managing a minimum of $250,000. We work with entire families and help our clients and their parents as well as their children by providing financial planning services. And so not only do we do investments, we also provide financial planning, and some of those areas include tax planning and preparation. We have a separate tax department with CPAs and enrolled agents for the exclusive use of our clients. Although we do not practice law, we help our clients review or begin their estate plan. We help also with retirement planning to assist with answering questions such as, do I have enough money to retire? We also help our clients as they enter different chapters of their lives, such as when they change jobs. We help analyze compensation packages or stock options, or when they get married, buying their first home, or have their first child. Also, we understand the importance for our clients to protect their hard-earned assets. Just like we do not practice law, however, we help with estate planning. We also do not sell insurance, however, help to review their insurances to be sure they are properly protected. In the challenging times many are facing with salary reductions and potential loss of employment, we are there for our clients every step of the way. So today we will be covering the third part of the 4-part series that is offered exclusively for CCA members. The first 2 parts we previously covered were investments and the healthcare system. Today we will cover Tax 101. Next month we will host a webinar about retirement, which we welcome you to join us. Do you recognize any of these terms? How about exclusions, deductions, credits? How about tax deferred or tax exempt? How about adjusted cost basis? Earned or unearned income, or realized and unrealized gains and losses? Well, today we're going to cover these terms as we look at the United States tax system and how it applies to individuals. And Today's presentation has 3 sections, and after each section, we will have some questions and answers taking about 1 to 3 questions after the first 2 parts, and as many questions as possible after part 3. So please feel free to send any questions to us via the chat feature. And we anticipate this presentation to last about an hour and a half. So a lot of people may think that tax is dry or boring, but it doesn't have to be that way. We will show you today that tax can be interesting and fun, or at least we'll try. For example, in section 1, we will go over the types of taxes individuals pay, but we will do that with some style. We will walk you through the special day in H's life and help you see the day-to-day impact taxes have on individuals. We will then briefly introduce the framework and the complexities of the United States tax system. For section 2, we will address income, estate, and property taxes. And in the very last section, we will provide some tax saving tips. So as I begin the presentation today, I'm going to be turning off my camera to feature our slide presentation, just as Shirley had mentioned. And we were going to be returning in our very last questions and answers section. So we'll see you in a little bit. Okay, Shirley, so H is our main character today. He seems like a very interesting guy. Can you tell us more about him?
All right, so H is an American citizen. He lives in New York and works full-time locally as a scientist at E Corp. H owns 3 properties in New York. One is his home residence that he jointly owns with his wife, and the other 2 are rental properties that he personally owns. And this is H's wife, W. W is a Chinese national with US green card. She lives in New York and works as a researcher at a local university. She jointly owns the home residence with her husband, H. Together, H and W has a son, S. S is 12 years old and goes to a local school. He helps neighbors with their yard and makes about $500 a month. H has a mom. Let's call her Grandma. Grandma also lives in New York. She is retired and very rich. Her net assets is about $15 million. On W's side of the family, W has a dad. Let's call him Grandpa. Grandpa is Chinese and lives in China, where he owns 2 properties. Even though retired, Grandpa actively trades in the US stock market. So here are the 5 family members. Please remember them, and let's begin our journey of this particular day in H's life. Morning alarm rang, and H got up. He walked to a coffee shop on his street and bought a cup of coffee. And ka-ching, he paid, and a receipt was printed with an item read, sales tax. Sales tax is a consumption tax, and consumers pay this tax directly at point of sale. It usually comprises of a state portion and a local portion. Take New York as an example. The statewide rate is a flat 4%, with the local rate vary between 3 to 4.8%. Here is an interesting question. What if this cup of coffee were purchased by Grandpa, a foreign national? Can he get sales tax refunded? Unfortunately, no, not in New York. In fact, most of the states in the US do not refund sales tax to foreign nationals. So we now know the sales tax rate in New York. How about other states? This is a map published by taxfoundation.org. It shows the average sales tax rate charged by each state. As you can see, Tennessee leads the nation with a rate of 9.5%. There are also states highlighted in gray in this map, like Oregon and New Hampshire, where there is no sales tax. You probably wonder, what if H drives to New Hampshire every week, does all the family shopping there, brings the good back to New York? He can save on the sales tax, right? Well, unfortunately, H will be hit with a use tax. Taxable goods or services purchased out of New York must be reported and subject to use tax if the goods were delivered or used in New York. Failure to do so could subject H to tax evasion penalties. After drinking his coffee, H hopped into his beautiful red convertible. He loves this car so much that he never thought about the tax consequences of owning it. See, H's car was imported. Therefore, the tariff was already built into the sales price. Even though tariff is levied on the importers, they almost always pass them on to the consumers through raising the sales price. H also paid sales tax. When H bought a car, the manufacturer gave him a generous rebate of $4,000. Unbeknown to H, he paid sales tax on this rebate too. There was also registration fee, title certification fee, and plate fee that H paid. Depends on where he lives, he might have paid county use tax and metropolitan commuter fee. Since buying this car, H has been subject to a registration renewal fee every 2 years, and possibly the metropolitan fee as well. After got inside his car, H realized the car is low on gas, so he put into the nearest gas station and started pumping gas. There again, he is paying sales tax. However, there are many other taxes that are built into the sales price of each gallon of gas, such as excess tax that's paid to both the federal and New York State. There is also numerous environmental fees that he paid. Excess tax comes in various forms. The registration and title fee are actually a form of excess tax. So Amanda, people usually call excess tax a sin tax. Is that term accurate?
Not exactly, Shirley, and I'm going to explain why. And unlike sales tax, excise taxes are not directly levied on individuals. It is imposed on the supplier or the producers, who then pass them on to the end customers by raising the product price or charging a service charge. When levied on goods, excise tax covers the so-called sinful goods, such as gasoline, tobacco, and alcohol, but it can also cover things like health-related goods and services. So that's why it's not exactly just a sinful tax. So as you can see in the graph, the largest contributor to the excise tax collected last year was actually highway usage. In the year 2019, excise taxes totaled about $100 billion, which is equivalent to about 2.9% of total federal tax receipts. So not only is there federal excise tax, but there's also New York excise tax. And they could be collected by the state and or the local government. For example, the state of New York charges the following excise tax amounts on these items that you see here on the page. And the tax on wine and beer is actually much less than hard liquor, so there's some differences there. So after pumping gas, H drove to work. When he got into the office, Lucy handed him an envelope and said, "Happy tax filing." Well, in the envelope was a W-2 form, which shows the payroll tax that was withheld from H's wage. So what exactly are these payroll taxes? At the end of the year, some employees receive a W-2 form, just like H did, from their employers, which shows the income they earned for the year, as well as some other details. In H's W-2, for example, box 1 is his taxable wage, and as you can see, it is $5,000 less than the wage amount in boxes 3 and 5. This difference of $5,000 is due to H's 401k contribution, as represented in box 12, code D. And the 401k contributions are not subject to federal or state income tax, however, are subject to Social Security and Medicare tax. An employee pays Social Security tax of 6.2%, up to a maximum amount of $8,537, And also they pay Medicare tax of 1.45%, which does not have a maximum. There are also a few items that are not subject to any tax, be it federal or state tax or Social Security or Medicare. Sounds pretty awesome, right? So what are these? In box 12, code W is H's HSA contributions, and code DD represents his employer-sponsored healthcare premium. These are not subject to any tax, so they are not included in boxes 1, 3, or 5. So just as you think box 12 is great that it shows all these non-taxable items, there's one thing noted with the code C, which represents H's group term life insurance premiums where the coverage exceeds $50,000. These premiums are taxable to H and are included in box 1, 3, and 5. So as many of you know, as employees, we are responsible to set aside a portion of our wage, also called withholding, for federal and state income tax purposes. H elected to have $8,000 withheld for federal and $4,200 withheld for New York. There is a penalty if H sets this number too low, and if too high, he is effectively loaning money to the government for free. So how much is H's take-home pay? Well, first we start with the $75,000 from box 1, which represents H's taxable wage. Then we subtract his withholding, so federal and state withholding, followed by Social Security, then Medicare. And lastly, H's portion of the group life insurance premium. This arrives at $56,530, which is how much H brought home throughout the entire year. How about on the employer side? The employer has to match the Social Security and Medicare taxes that the employees pay. Now, if H were self-employed, he would have to pay the employer's portion of the Social Security and Medicare tax too, which is also known as self-employment tax. In this example, the health insurance premiums is also paid by the employer. This is a fringe benefit that is not taxable to either the employee or the employer. So when H got home, he checked his mailbox, and there's a letter from the county showing that his property assessment went up. Therefore, his property taxes increased. He also noticed a check in the mailbox from his tenant from one of the rental properties. The rent he collects every month is subject to income tax, just like his wage income. So when H went inside, his phone rang. He picked it up, and it was his grandma. What did she say, Shirley?
I said that I'm thinking about moving abroad. I might relinquish my U.S. citizenship when I settle down. Relinquishing citizenship. Grandma might be subject to expatriation tax. Expatriation tax, also known as exit tax. It applies to U.S. citizens and green card holders only. And still, not every one of them has to pay. To qualify, one has to have a net worth exceeding $2 million, or over the past 5 years, one has an average tax liability over $171,000 or fails to comply with tax law. We know that Grandma has a net worth of $15 million, so she will be subject to this exit tax. Then how does it work? Well, expatriation tax is not an additional tax, but rather it is a capital gains tax levied on the unrealized gains. In other words, it's a tax paid on profit that Grandma hasn't made, but potentially could make if she sold all her assets the day before expatriation. The good thing is, Grandma only pays the portion of gains that is over $737,000 as of this year. Grandma further said to H that I'd like to gift you my house in New York. I also want to create a trust with income distributed to my grandson, S. We know earlier that S is only 12 years old, who is still a minor dependent to his parents. When you give trust income to a minor, this could trigger what we call a kiddie tax. Before this gift from grandma, S was only making $6,000 a year helping the neighbors with their yard work. This is earned income, as he exchanged his physical labor for money. The $6,000 a year is below the threshold, meaning S doesn't even need to file a federal tax return or pay any tax on them. However, when S starts making unearned income from this trust over a threshold of $1,100 a year, he now has the duty to file tax return. Besides trust income, unearned income also includes things like interest, dividends, and rent, etc. If it's over the threshold, S will have to pay kiddie tax on the portion of unearned income that's over $2,200. And the tax rate is his parents' marginal rate. We will talk more about this rate in the next section. Grandma is gifting H her house in New York. This will trigger gift tax liability. Gift tax is levied on the giver, so grandma will have to file a gift tax return. Let's say grandma paid $1 million on the house 20 years ago, and now the house is worth $3 million. H will inherit grandma's $1 million tax basis and potentially facing steep capital gain tax on the $2 million appreciation when he turns around and sells the house. After H got off the phone with grandma, the phone rang again. This time, W picked it up, and it's from a hospital in China. The doctor informed W that her father passed away. To the US IRS, Grandpa is a non-resident alien and non-US domiciliary, meaning he doesn't reside in the US, nor does he intend to call US home. As a non-resident alien, Grandpa does not subject to US capital gains tax on his stock trading account. However, if he bought a house in the US and sold it for profit, he would pay tax at a regular tax rate on the gain, as IRS consider buying and selling US real estate a conduct of a trade or business. While W was grieving over the loss of her father, she recalled that Grandpa had drafted a will where he bequested W his 2 apartments in China and his US stock account that has $70,000 balance. When Grandpa was still alive, the US stock account he owned was subject to withholding tax. Withholding tax is a flat 30% rate charged on non-resident aliens' US source investment income, which include income like a dividend, corporate bond interest, and rental income. The tax does not apply to bank interest or gains from shorting stocks. If US has a treaty with a foreign nation, the 30% withholding tax can be reduced. Now that Grandpa passed away as a non-US domiciliary, only his assets situated in the US will be subject to US estate tax. This includes US stock accounts, US real properties, meaning the 2 apartments in China will not be subject to US estate tax. But how much does he owe? For non-US domiciliary, there is a $60,000 estate tax exemption, meaning Grandpa only owes estate tax on the $10,000 that is over the limit. What tax liability does estate trigger for W? As a US resident, receiving a gift from a non-resident or foreign estate, W has the duty to report to IRS if such a gift is over $100,000 in a given year. Going forward, if she collects any rental income from these 2 properties in China or sells them for a profit, she must report again to IRS as income. So that concludes the special day of H's life. As you can see, the US tax system is very complicated. In the next few slides, Amanda will help you understand the why behind this complexity.
And before I do that, I just would like to let everyone know in the audience that we will be going into the first Q&A section in about 5 minutes. So please feel free to share any questions you may have via the chat feature. And as Shirley mentioned, the US tax system is complex. And one reason why is because it is comprised of multiple sources of law. So the core of our tax system is the Internal Revenue Code, also known as IRC. This is the primary source of law, and when printed, it has 3 volumes and over 4,000 pages. Surrounding the IRC, we have income tax regulations. These are issued by the Treasury to interpret the IRC. Tax regulations have the full force and effect of law. When printed, it comes to 6 volumes and over 14,000 pages. And on top of both of these, we have revenue rulings and revenue procedures. These are published weekly in internal revenue bulletins. We have had 30 bulletins published so far this year, and these are all lengthy publications with tens of thousands of words in each. These rulings and procedures will bind the IRS, but they don't have the full effect of law, so you can actually challenge them in court. So why is the US tax system so complicated? There is a statement from the Tax Policy Center that helps to explain why. Our tax system would be more simplistic if it was only to raise revenues, but we have other political agendas. Congress uses the tax system to influence social policy and delivering benefits for specific groups and industries. One example of the complexities of the tax system is the Tax Cuts and Jobs Act of 2017. This act is also known as TCJA, which is just one example of the complexities of our tax system and only scratches the surface. There is consensus that this act has provided some of the largest tax changes in the recent 3 decades. However, most of the major changes are set to expire after 2025. These changes include, for example, a nearly double standard deduction, elimination of the personal exemption, and doubling of the child tax credit. So far, one of the changes has already been repealed, which applies to the kiddie tax. This is a good example that shows how complex the tax system is and that it is practically changing almost daily. It is therefore important to work with financial advisors like us to help along the way as you maneuver through the tax planning and preparation process. So that concludes our first section. And if anyone has any questions at this time, feel free to submit them using the chat feature.
So like there's one person who, when signed up for the webinar, mentioned some questions about taxation on stock. He owns stock portfolios. So we're gonna touch more detail about that in our next section when we introduce the income tax. Is any gain from stocks trading would be counted towards an income. So we're gonna talk more about that.
Great. So I don't see any questions at this time, but if you do have any, feel free to submit them using the chat feature, and then we will answer as many as we can in the next section, which will be part 2. So in section 2, we will go over income tax formula, tax rates, estate tax, and also property taxes. And just as I mentioned, please feel free to share any questions you have. And we're going to answer about 1 to 3 or so in the next section, and as many as we can after in the final part. So there is a common formulary that helps explain federal individual income tax, which Shirley will further explain a little bit to us today.
Sure. To understand the income tax formula, we first need to address a few concepts. Exclusions. Exclusions are expenses that are not counted towards gross income. Things like employers' 401k match, HSA contribution made through payroll, and health insurance premiums that employers paid. Next, we have the above-the-line deductions, which is also known as adjustment to income. For most employees, these deductions include retirement contributions made through 401k or traditional IRA. For those who are self-employed, these deductions include a health insurance premium paid. Then we have the line, and followed by the below-the-line deductions. Every year, a comparison is made where we adopt the greater of a standard deduction and an itemized deduction to be our below-the-line deductions. As of this year, the standard deduction is $12,400 for a single filer, such as grandma. For a dependent like S, the standard deduction is the higher of $1,100 and his earned income plus $350. We know S makes $6,000 this year, so his standard deduction is $6,350 for this year. For itemized deduction, we look at expenses like property tax paid, medical spending, eligible charity donations, and gambling losses, etc. Now let's take a look at tax credits. Sometimes you hear people talk about deductions and credits interchangeably, but they are really different things. In most cases, tax credit is a dollar-for-dollar reduction of the income tax you owe. So a $500 credit is way better than a $500 deduction. I listed a few examples of the tax credits here, such as Child and Dependent Care Credit and American Opportunity Tax Credit. There are other credits too, and some of them are refundable. Now that we introduced the terminology, let's complete this income tax formula. We start from all income. We subtract the exclusions to arrive at gross income. Then we subtract above the line deductions to arrive at AGI, adjusted gross income. This is a very important amount, as many social benefits is linked to this value. We then subtract below the line deductions and further subtract exemptions. Note that exemptions has been temporarily eliminated by TCJA through year 2025. And subtract qualified business income. We arrive at taxable income. We then apply different tax rates to different parts of this income base based on taxable income based on its source. We arrive at tax. We then subtract tax credits and tax already paid. We get a final number that everyone cares about the most each tax year. Do I get a refund or do I owe money to IRS? It's easier to see the flow of this formula on Form 1040, also known as Individual Income Tax Return Form, that we file to the IRS. I have marked some key elements we just introduced. Additionally, Box 8B, circled in red, is AGI. Box 16, circled in yellow, is the total tax liability, which can never be negative. And Box 19, circled in purple, is the total tax paid and credited. If purple circle amount is larger than a yellow circle amount, congratulations, you will have a refund this year. If it's the other way around, meaning you have more tax liability than the amount you already paid, you will owe money to IRS. If too much is owed, you may face a penalty. Remember expatriation tax we introduced for grandma? One of its determination criteria is looking at this total tax liability number, meaning box 16 circled in yellow, from each of the past 5 years and average them out. If you look to the upper right of this yellow circle, you will see child credits. Having this credit above the yellow circle, meaning children and qualified dependents, can help you reduce your total tax liability. This reminds me of a story about a friend of mine who was born on December 31st. His parents literally scheduled a C-section to yank him out that day as a last resort to claim child credit and to reduce their tax liability of that year. They must be really desperate. See, some of the service that we do as financial planner is to help you plan ahead, so you have a good idea early on of the tax year how much your tax liability gonna be, and put aside the right amount in the purpose circle to avoid any last-minute surprise, any penalties, or the need to yank out a baby out early. So if you think about income tax formula, I use the plural, income tax rates. That's because different rate is applied to different sources of income. Amanda will show you what these rates are.
Yeah. So the United States adopted a progressive tax system for income tax. And what this means is the rates are like these glasses that you can see here. And as your income fills up each glass, the income in excess will be charged at the higher bracket. There are two common income categories in which tax rates are assessed. The first one is ordinary income and short-term capital gains. And the second is long-term capital gains and qualified dividends. So what is ordinary income exactly? Well, it is also known as marginal income, and it includes income sources such as wage, rental income, interest, dividends, as well as short-term capital gains. So short-term capital gains, they are gains on stock or mutual fund investments that are held for less than a year. And ordinary income is income subject to the marginal tax brackets, which range from 10% to 37%. And each rate is dependent on filing status and ordinary income earned. Currently, there are 4 types of filing statuses, and their respective income ranges is shown in the table here. So an example, for a married couple earning joint income of $120,000, their highest federal tax bracket is 22%, which can be identified in the 3rd column and 3rd row. So long-term capital gains and qualified dividends are taxed at 0, 15, or 20%. And long-term gains are gains on stocks or mutual fund investments that are held for longer than a year. Long-term capital gains rates are also dependent on filing status and taxable income earned that year. So for a married individual that has taxable income of less than $80,000, they may not have to pay tax on long-term stock investments that are sold, as the long-term capital gains rate is 0%. Kindly note that the gain from the stock sales are also included in their gross income. There are different or additional tax rates for collectibles, qualified small business stock, and net investment income tax. So net investment income tax is 3.8% additional tax on investment income if Maggie is over $200,000 if filing single, and $250,000 if filing joint. So Maggie, or MAGI, is AGI plus a few other items. Collectibles are taxed at 28%, regardless of your income. And qualified small business stock acquired after 1993 and held for at least 5 years incurs 0 tax for the first 10 million, or 10 times the AB if greater, and then 28% thereafter. So the US chart of highest state tax rates charged that you can see here in front of you, the highest tax rate is led by California at 13.3%, next followed by Hawaii at 11%, New Jersey at 10.75%, Oregon at 9.9%, Minnesota 9.85%, DC at 8.95%, and then New York. So New York's highest tax rate is 8.82%. And when our clients are looking to move for employment or retirement, we help them take into consideration the impact of taxes such as state tax. There are also states that do not have state tax, including Florida, Texas, Washington, Nevada, Wyoming, Alaska, and South Dakota. Some states only tax interest and dividends income, such as New Hampshire and Tennessee. So we talked about federal and state tax rates. Shirley, how do they apply to foreign nationals?
Right, that's another very complicated question. Is when it comes to foreign nationals, two different sets of rules are used to determine their income tax liability and estate tax liability. For income tax purposes, a foreign national is categorized as either a resident alien or a non-resident alien. A very objective test is used to determine their residency status. If a foreign national is a green card holder or has been substantially present in the US in the past 3 years, then she is a resident alien and will be taxed on her worldwide income. Think about W in our earlier example. If a foreign national does not meet the green card test or the substantial presence test, he is a non-resident alien and will only be taxed on US investment income or income effectively connected with a US trade or business. Think about grandpa in our earlier example. For estate tax purposes, the terms used are US domiciliary and non-US domiciliary. The test is more subjective, where the IRS looks at the foreign national's intent. Does he treat US as his home? How long has he been living here? What about the ties he has with his former country? It is a complicated factor test. Oftentimes, attorneys have to be involved to litigate a determination when there is a lot of money at stake. It is possible that someone is a resident alien for income tax purposes, but non-US domiciliary for estate tax purposes. Let's say someone is deemed US domiciliary, like W. Then she will be subject to estate tax on her worldwide assets. However, she is given a more generous exemption of $11.58 million as of this year. For those who are non-US domiciliary, say grandpa, he will only be taxed on the US cited assets, but he is given a way less exemption of $60,000 only. We will introduce the term exemption in a second, but for now, please remember these two numbers as we begin our next topics of estate and gift taxes. This table shows the estate and gift tax rates as of this year. Recall the two numbers just now? The 60,000 is here, corresponds to a rate of 26%, and the 11.58 million falls in the last row and corresponds to a whopping 40%. The takeaway from this table is that if estate tax is applicable, the non-US domiciliary will be charged at a rate of 26% or more, and US domiciliary will be charged at a flat rate of 40%. Amanda will show you the estate tax formula in the next slide.
So most people do not actually pay estate tax due to the lifetime exemption of $11.58 million for those domiciliary individuals, and exemption is $6,000 for the non-domiciliary individuals. So for domiciliary, this estate exemption is shared with the lifetime exemption of taxable gifts. Taxable gifts are ones that are made after 1976 with a value exceeding annual gift exclusion of that year. So for this year, the annual gift exclusion is $15,000. So for example, if I make a gift of $20,000 right now to Shirley, $5,000 will be over the annual exclusion and subject to gift tax. So I can elect to pay this tax right now, or simply let it eat away my estate exemption of $11.58 million. For a non-domiciliary individual, there is no lifetime exemption or gifts they can make. So if grandpa in our example is gifting Shirley $20,000, he will have to pay tax on that $5,000 that's over the $15,000 max. So how do we know if someone needs to pay estate tax? Well, first we compare the tentative estate tax base to the exemption. If the base is over the exemption, there is estate tax. Otherwise, there is not. With the above understanding, let's take a look at the estate formula. From the gross estate, you can deduct debts and state taxes paid to arrive at adjusted gross estate. We then subtract the marital and charitable deductions, add the adjusted taxable gifts made after 1976 that are not included in gross estate to arrive at tentative estate tax base. The base is compared to the exemption. If the base is larger, we apply estate tax rates to it and arrive at tentative tax. Total gift taxes paid are subtracted to arrive at gross estate tax. So is that it? Well, will we be paying this amount? See, we talked about the exemption. What this means is one only pays estate tax on amounts that are over the exemption. So for domiciliary, the exemption corresponds to a credit of about $4.5 million. This credit is subtracted from the gross estate tax in the form of a unified credit. If someone is widowed, the deceased spouse's unused credit can be included here too. We further subtract a credit for foreign death taxes paid, if applicable, and the credit for estate tax on prior transfers. So prior transfers are defined as the transfer of property to the present decedent for a transfer who died within 10 years before or within 2 years after the present decedent's death. Finally, we have the amount for the estate tax due. And Shirley will further explain how transfer of assets will be taxed for people of different residency statuses.
Thank you, Amanda. When assets are transferred between two individuals, different rules apply based on their residency status, nationality, and their relationships. For the giver, the U.S. look at their domiciliary status, so they are either domiciliary or non-U.S. domiciliary. For the receiver, on the other hand, what matters is their citizenship. They are either U.S. citizen or non-U.S. citizen. U.S. further looks at their relationship. Are they married or are they not married? Let's use the characters we introduced earlier to make things a little easier to understand. We know that W is a green card holder and H is a citizen, so they are both U.S. domiciliary. When gift or estate is passed from W to H, meaning from a green card to a citizen, she can use what we call unlimited marital deduction, meaning everything is estate and gift tax free. But it's not the same when H passes assets to W, which means from a citizen to a green card holder spouse. Because W is not a U.S. citizen, such a transfer does not qualify for unlimited marital deduction. Instead, H can only give $157,000 in a year before the gift tax kicks in. He is also limited by the lifetime exemption and estate tax exemption, meaning any amount over the exemption will be taxed at a rate of 40%. For both W and H, when they give assets to others, be it a U.S. citizen son or a non-citizen grandpa, they are limited by the same gift tax exclusion of $15,000 annual gift tax exclusion of $15,000 a year, and also the two exemptions. Now let's take a look at the other four scenarios where the giver is a non-U.S. domiciliary, such as grandpa. It doesn't matter if he gives it to a U.S. citizen, such as his grandson, or a non-U.S. citizen, such as his daughter. He only has $15,000 of annual gift tax exclusion and no lifetime gift exemption and a mere $60,000 estate tax exemption. The situation can be drastically different if he marries to a US citizen wife, where he can give her everything free of gift or estate tax due to the unlimited marital deduction. Deduction is slightly reduced if his wife is a foreign national. He will be limited by an annual gift tax exclusion of $157,000, no lifetime gift tax exemption, and again, a mere $60,000 estate tax exemption. Now let's take a look at property. What type of property is subject to estate tax and gift tax for non-US domiciliary like grandpa? So a big shout out to MinFin and Fin.com for compiling this beautiful table. As you can see, estate and gift tax adopt similar standards, though there are a few noticeable differences, such as cash deposit with US banks is subject to gift tax, but not estate tax. And US publicly traded stocks, municipal bonds, as well as life insurance cash value are potentially subject to estate tax, but not gift tax. So now we have looked at the estate tax on the federal level. How about on the state level? Amanda, could you help us walk through the state regulations and rules on estate and inheritance?
I'm sure I'd be happy to, Shirley. And so there are several states that actually do not have estate or inheritance tax. And the main difference between the inheritance and estate tax is the person who pays the tax. The estate tax is paid by the decedent, while the inheritance tax is paid by the person inheriting the assets. So New York is a state that has estate tax but not inheritance tax, as presented in green. For estates in excess of 5.74 million, New York taxes the estate. However, our neighbors in Pennsylvania and New Jersey have inheritance tax but not estate tax, as represented in blue. While Maryland has both, as represented in yellow. Understanding the state inheritance and estate tax may help people identify where they might want to live in the later years of their lives to avoid taxation. And next, we're going to go over real estate taxes. There is an exclusion on the sale of a personal residence of $250,000 for a single individual and $500,000 for a married filing joint. So how do you qualify for this exclusion? Well, you qualify if you own and reside in a home for 2 out of the last 5 years. Each spouse must meet the residency requirements individually, and any gain in excess of the exclusion is taxed at long-term capital gains rates of 0, 15, or 20%. So grandma gifted a house in New York to H, and if H decides to sell the rental property, he could be facing steep long-term capital gains. If H decides he would like to sell this house to purchase a rental property closer to home, he may want to consider doing a 1031 exchange. A 1031 exchange is a way to defer capital gains tax when selling an investment real estate property by reinvesting the proceeds into a similar property. To qualify, the property must not be a primary residence and not held primarily for purposes of selling it, such as those individuals who purchase a house and flip it. The new property must be equal or greater in price than the rental property sold. Title also must be identical. If the first house is in H's name alone, so should the new property. The new property must be a like-kind property. So like-kind is a very loose definition. This list shows you all the types of properties that can be deemed like-kind to each other. To do a 1031 exchange, A qualified intermediary must be used. All proceeds from selling the first property must be applied towards the new property. Once the property is sold, the seller has 45 days to identify a new property, and the transaction must be completed within 180 days. So if H doesn't want to manage another investment property anymore after selling grandma's house, he will not qualify for the 1031 exchange. So what are his other options to defer the capital gains? Well, he may actually want to consider a qualified opportunity zone. This is an investment program created by the Tax Cuts and Jobs Act of 2017, allowing for certain investments in economically distressed communities to have tax advantages. The main benefit is the deferral of taxes. To invest in this program, the capital gain must be invested into a qualified opportunity fund within 180 days. 15% of these gains are excluded from tax. And if the fund is held for 10 years, all further growth is excluded from income. Form 8896 must be filed through the Internal Revenue Service to create the fund. And the investment can be in real estate or directly in a business. However, the fund is required to have at least 90% of its assets in a qualified opportunity zone as seen in the next slide. And the opportunity zones here are seen in red and are spread out across the United States. So that concludes our second section. And we did actually have one question from the prior section that we'd like to answer today. And the question is, if life insurance premiums can be deducted from business income. So generally, life insurance premiums cannot be deducted from business income because they're for personal purposes. However, if the business has liability insurance, that potentially could be an expense used to help offset the income from the business, so that way it'll further reduce the tax owed. So thank you so much for your question, Amy. So Shirley, there is another question possibly you can help answer. So Lee asked, I am a resident alien with 15,000 in foreign banks. Do I need to pay tax for the interest? And if so, what tax form should I file? Thanks.
Thank you, Lee. So you're a resident alien. You do have to report your worldwide income. This will include the interest. So you just have to, while you file your 1040, you just have to include this interest, just like your other interest that you receive from American banks. For a resident alien, the worldwide income includes capital gains and also include all this other like a dividend or stock income. You can provide this interest income reported to them, and they are going to add this in. So like there's no special things that treatment for foreign interest versus domestic interest for a resident alien. And also depends on if US have a treaty with these foreign banks that you have money in. So you do have a reporting duty of telling the US government where the money is, and if you have interest or other income from these sources, and you have to report. Yeah, I hope that kind of answers your question.
Shirley, would you like to introduce the next section?
Sure. This is our third and final section of today. We're going to have a Q&A session. We're going to answer as many questions as you have. And then for this section, we're going to have 5 tips that we're going to share with you. So let's begin our tip number 1. Year-end catch-up contributions. So now it's the end of the year, and then you're worried you may have too much tax liabilities and not enough put aside. To avoid paying the penalties, you have a few options where you can bring down your adjusted gross income. So there were 2 opportunities for you. One is the exclusions. If your employer does any 401k match, you may want to max that. Also, if you are having a high deductible insurance plan where you have a HSA account, you may want to put aside as much money into the HSA to max it out as well. Both of these methods will help you increase your exclusions and so to reduce your adjustable gross income. Another opportunity is to work on this above the line deductions. So if you have a 401k or you have a traditional IRA, you may want to increase your contribution to these retirement accounts, and then through even in your last payroll of the year. And so this will help you increase this above the line deductions and subsequently reduce your AGI.
So tip number 2 is alternating the standard deduction and itemized deduction. So since the higher of the standard or the itemized deduction can be taken each year, it creates a tax planning opportunity for those individuals who are closer to taking the itemized deduction. The objective is to try to have enough deductions every other year to qualify for the itemized deduction. So this may be able to be obtained by doubling up on the charitable contributions in 1 year, when you have 2 years worth of charity 1 year and none the following, or by paying real estate tax bills early. This would lead to a higher deduction in the years you are itemizing, thus lowering your tax liability.
Tip number 3, gift your highly appreciated long-term stocks. If you are having if you sold your house this year and incurred a large amount of long-term capital gain tax, or you just sold some of your stocks and then incurred your, or if you just have generally making a lot of money and have a high taxable income, you may consider gifting some of your long-term hold stocks to your families or friends who have lesser taxable income. So if their taxable income is a married filing joint couple is less than $80,000 this year, they won't have to pay any long-term capital gain tax on the stocks that you gifted to them. So that can be a better way to do than you sell the stocks, pay the tax, and then give them the money afterwards. So this is just one way to consider when it's end of the year, what to give away as a gift.
So tip number 4 is the CARES Act new above the line deduction. So new this year as the result of the CARES Act is an above the line charitable deduction up to $300. This is available to taxpayers who take the standard deduction. So if you are charitably inclined, don't forget to keep your donation receipts so you can qualify for this deduction. And the last tip is tip number 5, which is maximizing your Roth IRA contributions while you still can. And the maximum Roth IRA contribution is $6,000 if you are under 50 and $7,000 if you are over 50, as long as your income is below the income limits. Since you can pull out the cost basis, which is what you contributed to the Roth, at any time without incurring penalty or tax, it can be used as a backup emergency fund for children's education or to purchase your first home. And purchasing your first home is actually an exclusion to the early withdrawal penalty. Due to the CARES Act, if you have a hardship related to COVID-19, you can withdraw as much as $100,000 from your Roth IRA without incurring the 10% early withdrawal penalty. Since Roth IRAs grow tax-free and there are limits to how much you can contribute each year, it will be important to take these into consideration prior to making any withdrawals from your account. So that concludes our presentation for today. We really appreciate everyone joining us. And if you have any further questions we can help answer, Shirley and I will remain on for a little bit to help answer any questions. So thank you all very much.
We're turning the camera back on.
Yeah,
Any questions?
Any questions at all, please? Thank you so much to those who did ask some questions today. We love to have an interactive webinar, and it's nice to give you all the opportunity to ask any questions you have at any time. So great. So while we wait for questions, maybe we can share with everyone our next webinar. So we're going to be doing a final webinar exclusively for the members here today. And the final one will be on retirement. And we really hope you can join us. And so that will occur probably next month at some time.
Thank you.
Yeah, well, thank you so much, David.
Thank you. Thank you.
Yeah, and our contact information is on the screen. So if you guys have a more personal questions that you don't feel comfortable asking right now, you can always feel free to give us a call or send us an email with the question, and we will get back to you. So.
Great. Well, I don't see any questions coming in. Thank you all so much for attending today. So that's going to be a wrap to the third webinar, and we hope to see you next month in the final webinar. So I hope you all have a wonderful weekend and enjoy the sunshine today, and we'll see you next month.
Yeah, thanks for joining us. We really enjoyed having you here, and then we'll look forward to see you again in our next webinar on retirement. We're going to address some of the employee benefits in our next section, as well as what to prepare for your upcoming retirement, or if your retirement is still a few decades away, and what can you do to best allocate your assets. And also, if you are already retired, and what are the things that you should be consider. And we're also going to touch briefly on estate planning for those people who are retired. And so, yeah, so it's going to be a great webinar. Hopefully we'll see you there.
Okay, very good. Well, have a wonderful rest of your weekend, everyone. Thank you so much for joining us and spending time with us today on your Saturday morning.
Thank you. Bye-bye.
Bye.